Welcome to This Week in South Carolina. I'm Gavin Jackson. With inflation at a near 40-year high, South Carolinians are feeling the pinch everywhere they go. But economic fundamentals remain strong, as does the state's labor market. For more details on the state's economy, I'm joined by Joey Von Nessen with the Moore School of Business at the University of South Carolina. But first, regional economist Laura Ullrich with the Federal Reserve Bank of Richmond talks to us. Laura, thanks for coming back on the show.
Absolutely, glad to be here.
So, Laura, let's start off by talking about the latest moves by the Federal Reserve Bank. They're trying to tamp down inflation. They increase the interest rates, continued increase in these interest rates. Tell us what they're trying to do. Tell us about these ripple effects and how we might feel them.
Yeah, absolutely. So they did another 75 basis point increase at the last meeting. So we're right under 3% now in terms of the federal funds rate. And they're trying to get inflation back to the 2% average target that the Federal Reserve has. And they've been pretty clear. Jerome Powell, if you've read his statements and read the statement that they released after the FOMC meeting, they've been pretty clear that they'll continue to do that until they feel like inflation is coming down. The basic gist behind it is that, prices are up because demand is up and supply has been down because of supply constraints, all the supply chain issues, and also some labor issues, right? So some companies aren't able to produce as much as they would like to because of labor shortages. And so we have a situation where we have higher demand than typical, lower supply than typical. And so that's kind of a very, if you've ever taken an economics class, that's kind of a textbook example of when prices would go up. Mm-hmm. And so what they're trying to do is reduce demand, essentially. So when interest rates go up, people will save more money, right? There's a greater incentive to save. And there's a lesser incentive to spend. There's also a lesser incentive it's more expensive to borrow money, right? And so you'll see consumers and businesses pull back a little bit. Right now, we haven't seen them pull back a lot. There are a few exceptions to that, probably residential real estate being the biggest exception. But as rates go up, we will start seeing some demand declines.
Yeah, we're seeing that tick down. We saw gas prices tick down a little bit. Obviously, that helped a lot when it came to new CPI numbers, too. So are those just a couple of indicators, too? Do we have any idea about what that could preclude when it comes to future rate hikes and how high we're going to go?
Yeah, so, I have a lot of people ask me that right now, how high is the rate going to be? And I don't feel like I can answer that question because it all depends on how consumers and businesses and governments and the global economy response to the rate hikes. Overall CPI did go down a little bit last month. And as you mentioned, that was driven by declines in gas prices. But core CPI, which we actually at the Federal Reserve use core PCE as our primary measure of inflation, which is similar to CPI, but the basket of goods is calculated differently, slightly differently. But those, core CPI actually went up last month. Core CPI is everything excluding energy and food. And part of the reason we look at that is that energy prices, including the price of oil, the price of natural gas, those are commodity markets, and really it's a world price. And so a lot of what's going on in Russia, for example, is in Ukraine is impacting those prices. There's not much that monetary policy can do about that. Monetary policy is unlikely to really impact that in a real way. And so we try to pay more attention to core CPI, which are more of the markets that we can have some influence on. And that actually went up last month. So that was a disappointing result for economists.
So, Laura, when we look at these rate increases, though, the markets have been responding a little hesitantly. They've been jumping all over the place, some bear market territory action. Is that just temporary pain for this long-term, hopefully, gain at some point?
Yeah, markets typically hate uncertainty, right? And there's a lot of uncertainty out there right now. And, I've been an economist now for about 20 years. And this is the most uncertain time I've been in that 20 years. We haven't had inflation this high in 40 years, right? And this period of time is so different than what we've had in the past that it's hard to predict what's going to happen 2 months from now, 6 months from now, a year from now. The geopolitical issues haven't helped with that because, if you look at what's going on over in Europe with Russia and the energy crisis that some of the European countries are facing because of their reliance on Russia for energy, that introduces a whole nother level of uncertainty, right? And so it's not shocking to me that the markets are reacting kind of in the way they are because they just don't know how to calculate what's next.
But at least there's a little bit more stability when we look at market fundamentals compared to maybe back in 2008 with the financial crisis.
Absolutely.
Yeah.
This is a totally different situation. And, that was a the financial crisis was driven by completely different factors, and there were real structural issues in the financial sector at that point. And the companies that we're talking to, and certainly the banks we're talking to, they seem really fundamentally strong for the most part. There's certain sectors in the economy where, they've been hit much harder than others, but overall, the companies in South Carolina and North Carolina that we're talking to on a regular basis are still pretty positive.
Yeah, I want to talk about the regional economy in a moment. Just to wrap up here with interest rates too and the global outlook. When we talk about concerns about recessions, we look at other central banks across the world, and they're also raising rates too to try and tamp down inflation. How concerned should we be about, possible global recession or a hard landing, as they're saying here in America?
There are countries that are in much worse shape than we are right now, due to some of the same issues, but then also due to additional issues within their own nations. And right now, the two largest economies that come to mind are Germany and England. Germany is having a really hard time because they don't have enough energy. They're going to face an energy shortage this winter, and they're highly reliant on Russia. And so that has created a huge amount of stress for that country. And then what's going on in Great Britain is also facing really high energy prices. And then, the new administration there, the new prime minister announced that they were going to cut taxes significantly. And the fiscal policy equivalent to raising rates on the monetary side is actually to raise taxes, right? Because as I mentioned, the goal is to bring demand down, right? And so you don't cut taxes on the fiscal side while you're increasing rates on the monetary policy side. And so yesterday, specifically in the markets, were really wild in the UK because of what's going on there. The good news for the US is that the dollar is really strong, right? Compared to many of these other currencies. I mean, the euro is at par, and the pound yesterday it was 1.07. And I was there this time last year, and I think it was 1.4 when I was there. So tremendous move in that rate. And the dollar is the world's reserve currency. So the dollar dominates global financial markets. And so we'll see some impacts, right? In the Carolinas, there are companies that are based in Germany and England that are going to have significant impacts from this, from downturns in those countries. But I don't think we're going to see too much of an impact overall in the U.S. economy from that.
Yeah, and it was also interesting, just to wrap up with the United Kingdom too, a lot of their home mortgages are also variable rates too. They're not fixed like we are here too. So they're going to have a lot of hurt, I would say, I guess, in the future too, and also some shocks.
This is one of these things where people a lot of times just don't kind of understand the fundamentals of economics, right? So if the central bank is having to raise rates to control inflation like we are doing in the US, they already have been doing in the UK, and then all of a sudden the government cuts taxes significantly, that is going to spur demand, which is going to make inflation worse, which means they're going to have to raise rates more. And so when you are in, a lot of people, I'm glad you brought up the mortgage situation there, because most people don't understand that this concept of a 30-year fixed mortgage is kind of a US phenomenon. And so consumers there could be hurt really significantly by those increases in Great Britain.
Glad to be an American right now when it comes to that.
Yes.
But Laura, I want to talk to you about maybe a little bit about the housing market too, because we are seeing it tick down a little bit. That's cooling off a little bit. Rents are going down a little bit. We talked about gas prices dropping. So these are just some of the things that come with the territory. But it seems like, again, we talked about the fundamentals being strong too. The labor market is still super tight right now. So kind of just give us a picture here about what the regional economy, what South Carolina's economy looks like in terms of its overall health.
Both Carolinas have really outperformed the U.S. overall in terms of employment and growth post-COVID. South Carolina overall is doing very well. I would say the metro areas, especially the larger metros, so Greenville, Charleston, the South Carolina side of Charlotte, are growing very rapidly and have healthy growth in very tight labor markets, very, very tight labor markets. It is important, though, to recognize that there are other parts of the state, especially the more rural parts of the state, that aren't doing as well, right? And some of these communities have faced longer term issues of population decline and companies leaving their counties. And a lot of those communities are the ones that are especially hard hit by inflation, right? Inflation hits low to moderate income communities harder because they spend a higher percentage of their income, right? So when prices go up, it hits them harder. So I would say it's kind of two stories, right? The one story is that overall South Carolina is doing very, very well, and I think that will continue. But the other story is that we do have parts of our state that have continued to struggle.
Mm-hmm. Yeah, and when we talk about that labor market, I mean, is it surprising to you that we're still ticking down? We're at 3.1%, I think, unemployment in South Carolina. Is that surprising when everyone's worried about potential recession, even though we haven't been declared in an official recession, even though we've had those two negative growth quarters?
Yeah, and the reason we're not in a recession right now is because employment's so strong, quite frankly. I mean, it has amazed me, the levels, we're still adding 500,000, 300,000, 400,000 jobs a month. That is incredible. We need to add about 80,000 a month to stay level with population growth and other things changing. So it's highly expansionary, but it's not too surprising to me given the demographic shifts. I mean, if you look at who's left the labor market since COVID, it is vast majority are people over the age of 55. So we've had an acceleration of retirements, and we just quite frankly don't have a lot of, that baby boomer generation is so large, and we don't have large generations like that behind them. Mm-hmm. And so the tightness doesn't surprise me too much given what's occurred. And I also don't think there's many reasons to think the tightness will change anytime soon because of those demographics. Now, places like South Carolina, they're one of the real positives through all this is that we have positive in-migration, right? So net migration is positive in South Carolina. I mean, I think about often if I was the Fed economist for Illinois or Iowa or Indiana, they're losing people. Mm-hmm. And so that becomes especially concerning because their tax bases are shrinking, right? And so that makes it really hard to recruit new companies and create new jobs and those sorts of things. South Carolina, there's people moving here every day, right? Lots of people moving here. And so you're going to continue to see job creation and new companies locate here because of where we're located, because of the weather, because of other factors. So I think for South Carolina, the outlook is quite positive. Mm-hmm.
And just the last question here, Laura, just what are you expecting? What are you watching for the next year, 12 months when it comes to rates, when it comes to the economy? What should we be paying attention to?
Yeah, there's several things. So one of the more concerning things to me recently in the CPI reports and PC reports has been how much rents have increased. Those tend to be stickier price changes, meaning, if your landlord increases your rent from $1,500 to $2,000, if prices then soften, they're not going to come back and say, oh, no, you can pay $1,700, right? That's not going to happen. And so those prices are sticky. And so we have seen it transition, the price increases transition to stickier things. So that's something I'm paying attention to. Also, the geopolitical stuff, I think there's additional risk of what could happen with Russia and Ukraine, but then also other risk out there too. I think we've definitely learned in this last year or so that we're not isolated from world events. That's something that has become very clear. And it's been a while since we faced that reality, right? It's been a minute. So I'm also paying a lot more attention to geopolitical risk than I was previously.
A lot on the horizon, but thanks for giving us a little update there. That's Laura Ullrich. She's a regional economist at the Federal Reserve Bank of Richmond. Thanks again, Laura.
Thanks for having me.
Joining me now to discuss the latest on the state's economy is Dr. Joey Von Nessen. He's a research economist at the Darla Moore School of Business at the University of South Carolina. Joey, welcome back.
Thank you, Gavin. Always nice to be with you.
So, Joey, I just spoke with the Fed regional economist, Laura Ullrich. We talked about inflation. We talked about the regional, the national economy, talked about interest rates. I want to talk to you a little bit more specifically about South Carolina, our economy, our future. And with that, kind of tell us what's going on right now with the state. We have low unemployment, wages are strong, tax revenues are kind of getting back down to normal. How do you see things in South Carolina right now?
Well, right now, South Carolina and the U.S. economy both are doing very well. And we see that across the board, including the metrics that you just mentioned. And what's really interesting about where we are right now is I think in many cases we're waiting for the other shoe to drop, right? Because there's this concern over a turn that might be coming, which is going to signal a major economic pullback and perhaps lead us to recession. But one thing that is important, one important metric I think that we don't hear referenced much is the fact that the American consumer checking account balances today are still significantly higher than they were back in 2019 by about 30% on average across all income levels. So that means that even though we're seeing high inflation and even though consumers are seeing their purchasing power eroded, in a manner of speaking, for a while, they still have additional financial resources to offset that. And as long as that's the case, we're not necessarily going to see a major pullback in consumer spending and an uptick in unemployment. But that is a temporary factor right now. And eventually, we're going to see these checking account balances get back to where they were before the pandemic. And then we're more likely to see an uptick in employment and a broader pullback in economic activity.
Mm-hmm. And Joey, when we look at inflation, we look at the 8%, 8.3%, I think, rates we're talking about, and I'm wondering how that affects different demographics of South Carolina and who's more at risk and who's getting the brunt of this versus who maybe is dealing with this better.
Well, it's eroding the purchasing power of all South Carolinians, and we see that across all industry sectors, with one exception, which is leisure and hospitality, so tourism, where demand has been extraordinarily strong, labor demand, because in a strong labor market, typically leisure and hospitality, that industry pays lower wages on average relative to most other industry sectors. And so in a period where we have a strong labor market in South Carolina, we see more people in that industry have an opportunity to move to other sectors and see a significant increase in their wages. And so in response, the leisure and hospitality sector, businesses there are having to raise wages at a fairly fast rate. And so as a result, we're seeing these sizable wage gains, and we've seen that over the last 2 years. So that's the one industry where we're not seeing as much of an erosion in purchasing power, but it's certainly happening across most other sectors in South Carolina. And the housing industry is the one that actually has been hit the hardest, where we've seen a major pullback this year.
Mm. Yeah, I want to keep it with leisure and hospitality for a moment. You're talking about wage gains there, so we're seeing some benefits as a result of this tight labor market when it comes to hiring folks for those jobs, because that was always a really difficult one to recover. And of course, with competition and the need, I'm guessing this is going to be some sort of long-term benefit for those employees in those industries when they can have more competitive salaries.
Yes, they have seen double-digit wage growth over the past year. So just significant gains in overall income levels, and that's been very good for the industry overall, for workers in the industry, because they have suffered significantly. The industry lost 50% of its total employment base back in 2020, so they've had a deep hole to climb out of. And another positive note in terms of leisure and hospitality right now is that they still have the wind at their back in a manner of speaking, because we've seen so much spending in the goods market over the last 2 years that we are still shifting back. The pendulum is still swinging away from the goods market and towards services. So that is going to continue to help feed the demand for leisure and hospitality, and hopefully continue to generate demand as we move forward.
Mm-hmm. And that is one of the more the higher markets too, the higher sectors, I should say, when we talk about employment, just the number of jobs that have come back to that sector. We heard from DEW Director Dan Elzy in his August unemployment release, where we saw the unemployment rate hit 3.1% in the state, saying that the dynamic of the labor market is ever changing, especially when you look at the number of job openings in the state. We're talking about 2 job openings for every unemployed South Carolinian. About how do we fill these jobs? How can we promise new jobs to the state if there's such a demand right now already?
Well, this is a problem, and this is something that we're going to be dealing with for the foreseeable future. South Carolina has a very low labor force participation rate relative to the rest of the country. It's about 57% compared to 62% for the U.S. And there are a number of reasons for that. One major reason is that we attract more retirees to South Carolina. So we just don't have as many people in the state that are necessarily looking for work. So when you combine that low labor force participation rate in general with the current labor shortage that we are facing, the strong demand, you do get a widespread shortage. And I think as we move forward, that's going to continue to be a problem for employers. And so they're going to have to get creative, and that could be more automation. It could be continuing to raise wages and offer other benefits, perhaps working from home. But employers are going to have to get creative. That's one thing I think that's very important to recognize is that this is not a short-term phenomenon. The labor shortage that we're seeing now is likely to be with us in South Carolina probably for the rest of this decade.
So, Joey, when you talk about labor shortage issues, what about recruitment when it comes to attracting new economic development projects to the state? Will we still be competitive in terms of bringing new jobs to the state? I mean, I know we have a lot of people coming to the state, a lot of them are retirees as well, but how does that mesh with what's going on in terms of bringing new industry, new jobs to the state?
Well, it does make it a challenge. The benefit of South Carolina is that we do have a very strong a strong geographic location in general, particularly for manufacturing. So that is a real advantage. We have good infrastructure, including the port and the rail and highway systems that give access to both U.S. markets as well as international markets. So you combine the port with local infrastructure in South Carolina. And we also are seeing a strong technical college system that continues to do well. And I think another element of this that we need to really focus on in South Carolina is to continue to build on the infrastructure and on the programs that we currently execute through the technical college system so well, meeting the employer demands to the workers, the individuals that are in South Carolina. So it's not necessarily that we need to reinvent the wheel or invent new strategies, but we definitely need to scale up what we're doing already because it has worked very well. We just need more of it.
Yeah, I mean, right now you can go to a technical college in the state and, get retrained, get a certificate for free, essentially, in one of these high demand fields. I mean, you can get a job, a high paying job right now, essentially for free and make a job career change if you need to at the state. That's at least what the governor's been pushing, that program that we saw come out of the pandemic, and we've seen state dollars back those programs up too and into some success as well.
And we know these programs work because employers tell us that they work. I mean, these are reasons that they publicly state in terms of why they're coming to South Carolina. They're not the only reason, of course, but they state explicitly that this is a major consideration that they have and a major reason and a major asset for South Carolina. So it's certainly working, and we need to continue to build on it.
Joey, keeping with the labor market, the quit rate in our state too, we're the fourth highest in the country when it comes to people quitting and jumping around to another job, obviously going back to just how competitive things are. But with the economy being a little maybe shaky right now, slowing down a little bit, should people be doing that? What's your advice to people who might jump to another industry or another job at the same time, being mindful that, first in could be, the last in could be the first fired in these situations?
It is risky. I mean, this is the best job market that we've seen in a generation. So if you're a worker, you certainly want to take advantage of that. If you do see new opportunities, you're having interviews, you're seeing ways that you can move up and advance your career. But yes, we know that it's almost a certainty that we're going to see a slowdown in the economy in the coming months. We don't know to what degree at this point, but if we do see a slowdown, yes, the last one hired is often the first one that is laid off. So I think if you're a worker, if you see an opportunity, you just need to keep in mind that if the economy were to slow down, would that affect the new job that you're considering taking? And I think just keep it in perspective that the strong economy that we're seeing now may not last for certainly not for the next year.
And when we heard from Jerome Powell, the Fed chair, talk about how yes, these rates are increasing. We're trying to tamp down inflation. As a result, we could see a softer job market in the future. Do you feel like that will actually trickle down? I mean, you're talking about having a strong labor market in the state, at least through the next decade. I mean, will we just see jobs almost like get absorbed? Some of these jobs that are open, maybe just not get filled instead of layoffs?
Yes, I think that one of the things that we have an advantage of in South Carolina is that we do have such a strong job market, meaning that any pullback in activity may limit the increase in unemployment. And we can have a mild economic recession. That's another, I think, important consideration to keep in mind, that most people in the workforce now, if you assume a 30-year career, the beginning of the Great Recession was now 15 years ago, which means that roughly half of the workforce today only sees an economic recession as basically an economic catastrophe because they experienced the Great Recession in 2008 and the COVID-19 recession. But a recession that's not normal. That's been very unusual, and we can have mild recessions. And if we do, South Carolina is in a position to weather it better because, again, we do have unusually strong demand here. And so a slight pullback in the demand for labor would not necessarily increase unemployment here as much as it might in other areas of the country.
Giving me flashbacks to 2008 when I entered the job force, graduating college right there in the middle of that recession. But Joey, with less than a minute left, I want to ask you just about South Carolina's exposure to the global economy, especially when we're talking about potential global recessions. We have a lot of global businesses here in the state. Well, what's your take on that? What should we be watching for? Do you think we will be affected globally because of the recession?
Well, manufacturing is certainly going to be affected, our manufacturing industry, because we are export oriented, meaning that we manufacture products here and sell them largely abroad to the global market. And if we look at two of our major trading partners in Europe, including the UK and Germany, they are almost certainly going into recession. They're going to face a very harsh winter because of energy prices. And so if they do go into recession, they're going to be buying fewer goods from the US. That's especially true for the UK, where they're one of the few trading partners we have where we run a trade surplus. So as we do see a global slowdown, I would certainly keep my eye on those two countries as they affect the US and South Carolina in particular. And manufacturing more generally, how we see these global events impact our export-oriented manufacturing sector here.
Gotcha. Well, we'll be watching, and that's Dr. Joey Von Nessen. He's a research economist at the Darla Moore School of Business at the University of South Carolina. Joey, thanks as always.
My pleasure, Gavin.
To stay up to date throughout the week, check out the South Carolina Lead. It's a podcast that drops on Tuesdays and Saturdays that you can find on southcarolinapublicradio.org or wherever you find podcasts. For South Carolina ETV, I'm Gavin Jackson. Be well, South Carolina.